Okay, so let's kick it off. What we're looking at here is called the blue marble. So this picture was taken in 1972 from Apollo 17, and what's remarkable about it is it's the first picture ever of our Earth as a complete sphere. And a lot of people would say this is one of the most defining pictures of our generation, because it made us realise that we're not just concerned about our suburb and our city and our country, we're actually concerned about the whole world, and there it is, and it's finite. And so what we're going to talk about today is how investing can change the world. And as investors, whether we're large investors or small investors, collectively together, we can influence company behaviour. And as we'll talk about, companies and businesses are a really important part of finding solutions for problems in the world. And as investors, we can actually influence and change the way they behave. So what we're going to do, we're going to talk a little bit about our world. You guys are going to be fully aware of what the challenges and issues are for the planet, so I'm not going to dwell too much on that. I see business as a really key solution to problems that we have, and we'll talk a bit about the role of business in society. We'll also talk about, as investors, how we can influence business, and then we'll finish up with just some positive thinking about the future. So we started with the blue marble, the Earth. We're just going to focus really quickly on a couple of points on Earth, and this is the sort of stuff that gets me really fired up about responsible investing. So the two places that are marked just above New Zealand is the Kermadec Trench, that is 10 kilometres underwater. And the other spot marked north of Australia, just by Guam, is the Mariana Trench. And the Mariana Trench is the deepest part of the ocean. It is 11 kilometres underwater. And at that depth, there is no sunlight, there is no plant life. Basically, everything down there has come from the world above. So scientists were interested to find out what exactly is down there. And in particular, they were looking for traces of pollutants, man-made pollutants, and had they reached the depths of the ocean. And what they found was actually astonishing, was that so they went to 10 different sites on these two spots, and what they found was pollution for the toxins they were looking for up to 20 times worse than the most grossly polluted Chinese river. And it's quite staggering, because this should be a pristine and untouched part of the world. And as The Economist magazine noted when they covered the story, no part of the Earth's surface is safe from the activities of man, and we'll just add to that, all women. But it's quite staggering for us that somewhere that you think should be untouched is contaminated. And we're all aware of the challenges that our world faces, social challenges around population growth and what that means for the planet, social change around urbanisation, particularly in developed markets, inequality of wealth, environmental challenges, resource depletion, loss of biodiversity, and climate change. So there's no end of challenges, and we don't want to focus on those tonight. What we really want to focus on is solutions. And sadly, I can't tell you what the single solution is going to be that will make things better for our world, but what we can think about is where those solutions will come from. And I'll just share with you 4 ideas of where I think are some of the key places that solutions will come from. Firstly, government. And everyone has a different view on government. Some people want more government and more rules, or less government and less rules. But government, through regulation and through tax, has a critical part to play in generating solutions. Secondly, belief systems. So religion, for example, is a guide for many people how they live their life. Religion and belief systems has a huge part to play, and that goes further than religion. It's also belief systems around economic systems. For example, socialism, capitalism, free markets. Where we settle as a society on our economic system will have a big impact. Thirdly, technology. Technology can change the world. We've seen that with Sharesies and what Sharesies can do for investing. Technology generally can change the world. And that leads us to our 4th reason. Where does most new technology get developed by? It comes from companies and businesses. Businesses develop new technologies. Businesses are critical to the solutions for our planet. So we've talked a bit about our world, and we're going to focus on business as one of the solutions for the problems of the world. And we're going to talk about the role of business in society, which changes over time. So if we go back to 1600, in 1600 under a charter, the East India Company was formed. And essentially this was a company that ran the British Empire's interests in India through the 17th and 18th century. It was a massive company. It had its own private army that was bigger than the British army. And the East India Company, one thing I've always found amusing with it is in its profit and loss statement, it actually had a line for booty, which was essentially you can go and capture ships from other countries. You go and grab a Spanish ship and take all the gold off it, and that's revenue for a company. So companies can't do that anymore. Companies can't go and capture ships and take the booty. So the role of a company changes over time, and what's acceptable or not acceptable for a company changes over time. And in the September edition of Fortune magazine this year, they asked a really good question, which is, what is the role of companies in our free market society? Should companies be conscious, or should they just consciously pursue profit? And it's a really good question because there's a wide spectrum of views on what the role of a company is. At one extreme, we've got thinking of Milton Friedman, who's a Nobel Prize winning economist. So his view is the business of business is business. And what he's saying is business is there to make money. Values do not come into it. Social responsibility does not come into it. Companies should maximize profit as long as they're not doing anything illegal or committing fraud. And then they pay dividends to shareholders. It's up to the shareholder to decide, what do I want to do with the money? Do I want to spend it? Do I want to save it? Do I want to give it to charity? So the social responsibility part comes for shareholders, not for companies. So that's one end of the spectrum. The other end of the spectrum is expressed really well by a guy called Larry Fink, who's the CEO and founder of BlackRock. So BlackRock, which you may or may not have heard of, it's actually the largest asset manager in the world. It manages about 9 trillion New Zealand dollars of assets worldwide. So they invest in a lot of companies, and every year they write a letter to the companies they're invested in, and they say, these are our expectations from you as a company. And in the last letter they sent, they said, we expect companies to serve a social purpose, and we expect companies to benefit all their stakeholders. And how they define stakeholder is employees, shareholders, and local communities. So that's a big change from Milton Friedman's thinking. And I heard a talk by the CEO of Patagonia, which is a really cool sustainable clothing company, and they take it even further. They say our number one stakeholder is the planet, which is for a leading businessman, that's a really interesting approach to take. So we've got these two views on what is the role of a company. Making money, no values, or you've got to be conscious about your community around you. And what I want you to do, we're just going to take 30 seconds, turn to the person next to you, whether you know them or not, just turn to the person next to you, and we're just going to 30 seconds where you guys are just going to have a chat on which end of that spectrum you sit on, and then we'll just check back in as a group and see where we're sitting as a group on that. So 30 seconds. Sorry, our 30 seconds is up. Can I get us to reconvene? And I'm really interested in where people sit on this spectrum. Can we have a show of hands who agrees with Milton Friedman that businesses are there just to make money, and then shareholders can do with that money whatever they want to do with that money? Show of hands. Cool. So we've got a few hands. And at the other extreme, we've got the we'll call it the BlackRock view, where companies should be socially conscious. Anyone? Cool. And I think there's a few who either aren't sure or who don't care in between. But look, pretty well overwhelmingly, people are saying that companies should have a social conscience, which I'm glad you guys said that, because that's my personal belief. And why would a company do this? Why would a company have a social conscience and say, okay, let's spend some money on doing the right thing? And I'm going to give you 3 reasons why. The first reason is values-based, and this will often be driven by the CEO or by the main shareholders saying, we just want to do this because it's the right thing to do. And it may cost them money, it may not make them any money, but it is just the right thing to do, and it sits with their values. More likely, it's about sustainability. And a company is saying, okay, rather than just looking a year ahead, I'm going to look 10 years or 20 years ahead. And then they realise there are resources they need. They need to look after a local community for the labour force. They realise they actually need to do some stuff to make their business sustainable long term. The third reason is reputation risk, which is probably the most likely. Companies care what consumers think. Companies care what society as a whole thinks. There's a lot of reputation and brand damage at stake if they do the wrong thing. And if we think about 2016 in New Zealand with KiwiSaver, you remember there was quite a shock when everyone found out they had cluster munitions manufacturers and landmines and tobacco manufacturers in their KiwiSaver funds. And the banks and large providers scrambled to get those out of the KiwiSaver funds. Now, I don't think the banks were doing that on a values basis, because if they actually thought it was the right thing to do, they would have done it a year or two before. They were doing it on a reputation risk basis. They were really concerned about what consumers thought of their business. So it's good for business to do the right thing often, because it protects the brand, and that's also good for our community. So I'm just going to show you a couple of interesting websites that illustrate the point. So what we've got here is designing a smoke-free future. How long will the world's leading cigarette company be in the cigarette business? This actually looks like an anti-smoking campaign, anti-smoking charity. It is in fact Philip Morris. Now Philip Morris is the largest tobacco manufacturer in the world and has some of the world's leading tobacco brands. So their website is littered with discussion on social responsibility, on the health dangers of tobacco, on the responsibility they have to move people away from tobacco. And again, I don't think they're doing that, given the history of tobacco. I don't think they're doing that on a values basis because they believe it's the right thing to do. They're doing it because they're looking 50 years ahead, and they're saying, particularly in developed markets, with regulation and tax and changing consumer values, they won't have a business or a product in 20, 30 years' time. So they're transitioning, and they're being a leader in transitioning people into vaping and different products as substitutes for tobacco, not because they think it's the right thing, but they think it's sustainable for their business going forward. Another example is this New Zealand listed company called Sanford, and if any of you through Sharesies have the NZX50 ETF, then you will have a small holding in Sanford. So Sanford is a fishing company, and on their website, and when you hear their management speak, they talk a lot about sustainability. And they, looking into the future, they realise, with fish, they have to have a sustainable environment. So in 50 years' time, they are still fishing. They have to look after local communities to know they have a skilled workforce to employ in the future. So they're very concerned about social responsibility issues. So we've talked a bit about the role of business in society, and we're going to think about how, as investors, we can influence companies by investing responsibly. So in my mind, there's a new way of investing. The old way of investing is just invest in anything, cluster munitions, whatever, and make money, maximise profits. The other way is taking a more positive approach, trying to influence companies on the way through, and actually by investing in companies that care more about the environment and about society, you're generally investing in more resilient companies and better companies. So it's not going to cost, I suppose is the point. You're going to do at least as well as the market. So we'll talk a bit about that. So one thing to look at is just what are influential investors globally doing, and what are sophisticated investors doing with their money? How are their investment patterns changing? Really good example is the Norwegian Sovereign Wealth Fund. So this is, like in New Zealand, we have the sort of $40 billion New Zealand super fund. This is kind of the equivalent in Norway, but it's a bit bigger. It's $1 trillion. In fact, it's the largest sovereign wealth fund in the world. And they're divesting high carbon assets. They're selling oil and gas shares in their portfolio, which is hugely ironic given that Norway built up this $1 trillion fund through revenues from North Sea oil, but they're now saying as a climate change issue, we shouldn't own these assets, we need to reduce exposure, there's too much concentration risk with climate change going forward. And large pension funds, including the New Zealand Super Fund, are doing that globally. They're recognising from a responsible investment perspective that you want to reduce the carbon exposure in your assets. And so we've got the large sophisticated investors making changes. What about us in the room? What about people in New Zealand? How do they feel about their KiwiSaver? And there was a really interesting survey done by Responsible Investment Association and Mindful Money earlier this year, and they asked New Zealanders, do you want your KiwiSaver managed ethically and responsibly? And 7 out of 10 said yes. 10 said no, 20% not sure, but 7 out of 10 said yes. So a really powerful message. And the question is, how do you do that? It's fine to say, I want my investments managed ethically, but how do you actually do that? And the traditional way of doing it is just to avoid investing in stuff you don't like, so exclude it. It can be controversial weapons or thermal coal or gambling. Just don't invest in those things. Regard them as bad industries and avoid those companies. And I suppose from our perspective, we see that as a really negative approach to responsible investing. It's not a positive approach, and it's probably not going to change the world just by avoiding investing in some companies. So we take a much more positive approach in how we invest. The first thing we do is called ESG investing. So that stands for environmental, social, and governance. And we focus investment into high-scoring ESG or environmental, social and governance companies. And it kind of makes sense intuitively if you think of a chemical company. And a chemical company that manufactures chemicals and then distributes and transports them, they need strong environmental policies and practices and good safety record. Otherwise, at some point, they'll have a spill. And if they have a spill, there'll be massive cleanup costs, there'll be government regulation, and the business could go bankrupt. So the long-term viability of the company is effective if it doesn't have a high E score. The E score is a social score. You know, we care about many things there, but one of the things we really care about is how do they treat their labour force. So typically, if you have a large labour force and you pay them fairly and you give them good conditions, then they're more loyal to the employer. You'll have lower staff turnover, fewer sick days, more productivity out of your workers. You'll actually make more money. So a high S score can often lead to a more profitable company. And then governance, which is the structures around the company, including shareholders and directors. Better governed companies generally manage their risk better. So we're focusing investment into high environmental, social and governance companies. The other thing we're doing is engagement. So with engagement, we are voting and lobbying as a shareholder to affect change with companies. And we all think, you know, as small shareholders with our KiwiSaver or our investments, how are we ever going to make a change? But actually collectively it does matter. And in the US, ExxonMobil, which is in the top 10 largest companies in the US, a year ago, they had a shareholder vote, which management didn't want, but shareholders forced on them. And the question was, should the company assess the climate change impacts of long-term capital spending? And shareholders voted yes against management wishes. So small shareholders and large shareholders can have an impact and can change company behaviour. So what we're looking at with this environmental, social and governance or ESG investing, we're essentially saying there are companies in good industries, because we haven't excluded those industries, they're not tobacco and landmines. There are good industries, but there are bad companies in there we want to avoid. And I'll just give you a couple of interesting examples. So one of them is Facebook. In our Global Responsibility Fund, we're not invested in Facebook. That's worked really well in the last year. Facebook's share price is down quite strongly. And that's because of its G factor, its governance is very poor. Bloomberg yesterday said Mark Zuckerberg is accountable only to himself. He held some majority voting shares in Facebook and he is chairman of the board of directors. He controls the company. It is like a startup or venture capital business that is now hugely influential and large, but it still has a small company structure with one person running it. On that basis, it's uninvestable to us because of the governance. We don't know where the risk or where the problem's going to come from in the company, but it will lead to problems. And then we've seen that in the last year. We've seen that with influencing US elections. We've seen it with Cambridge Analytica and the not protecting data properly, massively impacted on Facebook's reputation, and it will impact on its profitability as well. So low ESG scoring company. The other example is Volkswagen. You guys will all be aware of 4 years ago, Volkswagen was caught cheating on carbon emissions. Diesel emissions. So they had software in the cars that reduced the emissions when it knew it was being tested. And this is not a low-level decision within a company. This is a high-level decision. This is part of the culture of the company. A company like that becomes uninvestable to us when it has that embedded culture until it can change, until generally there's a change of leadership. And that has worked for us. Volkswagen share price down over the last 5 years, and also they were involved in a bizarre experiment earlier this year where they put monkeys, and this just shows the culture has not been fixed. They put monkeys into containers and connected it up to the exhaust of cars, and they were testing the impact of the exhaust on live monkeys. And the head of sustainability at Volkswagen, who had signed off the experiment, had to resign as a result of it. So I don't know what planet they thought that was ever going to be a good idea. So this responsible investing thing, we're influencing companies and we're focusing investment into what we see as good companies, high environmental, social and governance companies. It all sounds good, all sounds nice and fluffy, but does it actually cost as an investor? You know, we're saving for retirement, we want to maximise our returns. Will this cost us? And I'm pleased to report the international research from Credit Suisse, from Macquarie, from Oxford University, from Bank of America is overwhelmingly saying you will do at least as well as the market by investing on an environmental, social and governance basis. You may end up with a lower volatility portfolio. One really good piece of work, which was a 10-year study of US stocks, said that if you only invested in the top half of companies in the US on the basis of environmental and social scoring, you avoided 90% of bankruptcies. So what it showed is that companies with high ESG scoring are much more resilient companies. So we've covered off investing responsibly and the role of business. We're just going to think really quickly about the future. Because there's a lot of change going on, and you guys have seen this in your lifetime. The rate of change for technology is getting faster and faster, and there's also change in investor patterns and consumer behaviour. And an example I really like is Forest and Bird in New Zealand, which is a large charity, has over 80,000 members. Earlier this year, they changed their banking relationship from ANZ to Kiwibank. And the reason they did that, they decided that ANZ lending to fossil fuel companies was incompatible with their values on wanting to preserve the environment. So they moved their relationship. And that sort of conscious consumer movement is going to get stronger and stronger. And we're seeing offshore, for example, in Europe, where they're probably ahead of the curve compared to New Zealand, a company or bank like BNP Paribas, which is a really large bank, they have stopped lending to tobacco companies. And they've stopped giving mergers and acquisitions advice to tobacco companies. Really profitable business for them, but they've turned their back on it because that's what their investors and their consumers want. And so we're seeing change, social change, and a lot of that is driven by generational change, which makes it really exciting to be involved with responsible investment. So in this study in the US, people were just asked, are you familiar with the term socially responsible investment? And the amazing thing was that twice as many millennials said yes compared to people aged 60 and over. So almost 9 out of 10 millennials said they're familiar with the term socially responsible investment. So that's going to have a huge impact on the way as a country we invest going forward. So I'm just going to wrap it up now. We've talked about the problems of the world. We've talked about how business is one of those solutions. What I firmly believe is that investors collectively, we have the opportunity to change company behaviour, and it's not going to be just by excluding landmines and tobacco. It's going to be by focusing investment into high-scoring environmental, social and governance companies. We will lift standards of other companies. Regulators are requiring better disclosure from companies around environmental and social risks. So as more information becomes transparent, it's going to be easier to make decisions for investing around that. And the other big change we can make as investors is engaging with companies to effect change. So there we go, back to the blue marble again.